let's talk about hedging. I think now, now's it's a, you know, timely topic. Ideally, you want to have hedges in place, when markets are around all-time highs. We'll go back over, let's just actually look at the SPY. Um, okay, so when a sell-off has already occurred, that's not when you want to put a hedge on. You want to put hedges on, and I like to generally always be hedged to some degree, but certainly when we're at market tops, okay, is the most opportune time to hedge. And there's a lot of ways to hedge. And again, I got this question a number of times from attendees of the Money Show last week, and uh, kind of my main message here is, well, occasionally I will individually hedge a position. So, like, let's just say if I had a long position in Nvidia, I may uh, hedge directly, using options, whatever. But so Nvidia options. But for the most part, I actually hedge with correlated products that are not, specifically whatever I'm trading. So this is something that can be done in a retirement account, an IRA. Um, you can do this in your, if you have a long portfolio. Uh, One of those ways is, and we talked a lot about this and looking at different strategy, is using the VIX, because of course, if markets sell off and you have a portfolio of correlated bullish positions, um, the VIX is going to go up. So you can, use a VIX call or VIX call spread to hedge. Um, Another approach that I like to use is using a correlated index to set up a different type of hedge, which I'll talk about here. So like if you own a basket of stocks in the S&P 500 or even 100, okay, you can use the SPY or the SPX. If you own tech stocks, you can do this on the QQQ. But this is a technique. Well, you can do this with individual stocks. One that I typically set up on index products like the S&P or the Nasdaq. So we'll stick with the SPY and go over to an options chain here. And kind of a common approach is just to buy a put option. All right, so we call that a protective put. The problem with that is, number one, over the long term, um, that can become expensive, and it actually, uh, if you're, trying to hedge a portfolio of S&P stocks, can really eat into your long-term profit potential. Um, because put options are expensive, right? They're priced at a premium. So there's a way to address that. So I'm going to go out. I'll give you. So step one, right? Let's start with step one. Is expiration selection. All right. And for that, um, this is to some degree discretionary. You can kind of decide how far out, depend. This is largely individual, depending on your outlook, your portfolio. So there's not like a set rule of thumb for would apply to all traders and investors. But for me, I typically like to go out if I'm gonna, set up a hedge, 30 to 60 days to expiration. Um, so let's go out to the April monthly expiration cycle. So these are 51 days. So within this range. Okay, so April 17th, we'll do the PM settlement. Oh, I'm on SPX. Let me just go to SPY. We were looking at the SPY chart. Okay, so we're going to go to April 17th. Okay. So here I can set up a hedge that will protect my portfolio for the next 51 days. So how am I going to do this? So we'll go to step two. Let me clear this out. All right. Now, This hedging technique involves buying a put, but again, the put options are expensive. They're priced at a premium. So we want to reduce that cost as much as possible. And we can actually often do this for break even and get the market to pay for our hedge. And so we're going to do that by selling a bear call credit spread. So I'll give you the rules behind this, but we'll start with the purchase of the put. So the idea here is to hedge a long portfolio in the event of a major market sell-off. So we're going to start with a lower delta put option. All right. And typically, let me kind of scroll here down a little bit. I'll start with around a 20 delta put. Okay, so we're going to look at the delta. And looks like we've got a 20 delta at the 563 strike. Okay, so these are number one, priced at a lower premium, down at a 20 delta. Okay, so this is, let's see, 20 delta. These are offered at 509 a contract. All right, so if we were just to, buy one 563 strike put, we would pay a premium of $509 a contract. But now what happens if over the next 51 days the market doesn't sell off? What if it just stays range bound as it is now? Well, then these would expire out of the money and we would lose that $599 premium. Okay, it's just like insurance, right? You have an insurance policy on your home and nothing happens and you lose your premium. Okay, well, there's a way to, and it'd be great if there's a way to do this in other insurance markets like homeowners insurance or auto insurance. Unfortunately, there you lose the premium you pay if you don't have to use the protection. Um, the options market, we have the ability to not lose that premium. So we're going to finance the cost of the protective put, which again we're going to buy at a relatively low delta, around a 20 delta. By selling a call spread. And we're actually going to do this at a 1-to-2 ratio. So for every one put contract that we purchase, we're going to sell 2 call spreads. And this is going to vary depending on, market conditions, levels of implied volatility. So this isn't a set in stone rule, but you may have to kind of play around with the strikes a little bit. But typically I'll go like around a 30 delta on the call side. So let's just start there and see if this actually works. So a 614 strike call. We'll start there. That's a 30 delta. Okay, so I'm just looking at the delta column, going down to a 30 delta. All right. So these have a high probability of expiring out of the money, about a 72% chance. Okay, that's purely statistically speaking, not in any way incorporating any technicals. Obviously, there's major levels of resistance below that we just looked at on the S&P chart. So it's probably lower. And of course, in terms of momentum and trend direction, we're rotating lower in markets right now. So this may be understated, but kind of just a good rule of thumb or starting point. But we'll start at a 30 delta. So what we'll do here is we're going to do sell vertical. Starting with a 30 delta for the short leg in the call spread. So again, we're going to be collecting a credit here to help pay for the put protection. Now for the long strike in the call credit spread, we're going to need to widen this. So typically If we start with a 30 delta call for the short leg, um, I may go down to like a, let's see, around a 20 delta for the long leg. So that would be what, a 621 strike. Let's see what that looks like. I'm just doing this exactly as I would normally. I haven't really done any preparation for this, so I'm not sure how this, we may have to mess around with this a little bit. Um, but let's look here. Okay. So if we, for every one contract we buy in put protection, we do this at a 2-to-1 ratio. We sell 2 call spreads. So this can be adjusted in terms of position size to meet your hedging requirements, obviously. All right, but at the midpoint here on this spread, I could collect, looks like 212, so $212 a contract. So again, we're doing this at 2-to-1 ratio, so that would be what, $424. So that almost pays for my put, but not quite. Let's bump it up the long leg up to a 622 strike. Okay, again, that's going to be 4, so that's pretty close. Let's go up to 623. All right, so actually we could do, if we do a 9-point wide call spread here, we could actually collect a net credit. I try to do this for close to break even. If we go down to a 6, for the long leg, if we do a 622 strike, it wouldn't quite get us there because remember that protected put costs us, I think it was $509 a contract. So, okay. So we'll go to a 623 strike for the long leg and the call credit spread. And for that, we would bring in 258 a contract. Since we're doing this at a 2-to-1 ratio, that would bring us in $516. So that would pay for the protective put. Okay, that would pay for our 563 strike put. Now, if the market remains range bound and our puts expire out of the money and the market, stays below 614, then we didn't have to use our hedge, our protective put, but we didn't lose money. If we hadn't set up this call credit spread, that decay in the protective put premium, and ultimately it would be a full loss of premium if you held that to expiration and expired out of the money, would eat into our portfolio when we may have never needed that put protection. So by selling the call spread, okay, that finances the cost of that put premium. Now, when you hedge, you don't ever want to hedge 100% because then the hedge becomes the source of the risk. So the rule of thumb is you typically want to hedge off about 30% of your portfolio. So the question, of course, is what if the market then rallies to the upside? Well, if you hedge about 30% of your portfolio, you'll still make money. Because of course, on an upside move, you would lose on your put and your protected put and your call spread, but that's okay because you have, right, you're hedging a long portfolio. This is meant to be a hedge and not, a full speculative position. You can certainly do these as speculative trades, but by structuring the hedge this way, you're reducing the risk of, and this isn't a one-time thing, right? So we do these over and over again. Reducing your risk of over the long term having that put protection if for people that just simply go out there and buy a protective put, eating away at your portfolio.